Many investors look at a company's PE ratio, or otherwise known as price to earnings ratio, as a way to value the stock price, whether it's cheap or expensive. For growth stocks, however, like Tesla, the problem with using the PE ratio is that it only looks at 1 year's worth of earnings. So today, let's review the data to see whether you think Tesla stock is priced correctly, too low, already too high. Our guest today, who did this analysis, is Cern. Cern is a chartered financial analyst. He's currently running his own investment advisory firm called Brilliant Advice. Thank you so much, Cern. I appreciate you joining me.
Thanks for having me.
So this is a good topic because Tesla stock, that's the big battle. Everybody's always out there going, it's priced too high, it's priced too low. The stock is, fairly priced because don't you know that the future earnings have now fallen? We're no longer at the 50% growth rate. And yet some of us are long-term investors and we're saying, but don't you know that Tesla is about to get a tremendous amount of earnings, because here's what bot will do, here's what autonomy would do, here's what energy will do. So tell me what it is that people are doing right and what they're doing wrong when they look at the PE ratio or other metrics for that matter.
Well, the short answer to that question is the PE ratio, in my opinion, is a useless metric because it's looking at the price of the company, its market cap or the price of the stock over some measure of earnings. And as you mentioned, that usually that measure of earnings is a very short time period, right? But I think it's pretty obvious to state that when you purchase a company, you need to consider the value of all of its future revenues and earnings, not just 1 year. And yet the PE ratio looks at just 1 year. The PE either based on last year's earnings, or sometimes it's a PE ratio based on forward-looking earnings for the next 12 months. Both of those are deeply flawed because, again, it's just one portion of the value that that company is going to bring over time. So one of the classic mistakes is to look at a company and say, oh, the PE is cheap, but it might be a company that has high earnings today, and over time those earnings will decline because it's a declining business. Think about Kmart, for example. Likewise, on a company that's rapidly growing, the PE ratio may appear to be very high today because the earnings today look very low, but you're failing to take into account this massive growth that may come in the future. So that's the problem with PE. If you throw up the chart, Herbert, of the PE ratio for Tesla, we can kind of show this. This is a PE ratio looking at the last 12 months earnings. So it's going back in time. There's no projections here. It's what did the market value.
And that's the standard PE ratio, right? Just looking back past 12 months.
Yeah, it's the most the most standardly used, I guess, if that's a term. The PE ratio for Tesla, looking back over the last 12 months, it's currently trading at about 60 times earnings. Okay. Now the challenge with that is that good? Is that too high? Is it too low? You can see there on the left that at one point it traded at 400 times its past earnings. Well, that seems kind of high. And then it came down, and now it's at 60. So is 60 high or low? Right? And there's no answer to that question. That's an impossible question to answer. You have to say, well, relative to what?
Right.
Okay. So we can say, okay, let's make it relative to NVIDIA. Let's look at NVIDIA's PE ratio for the last 12 months. Here, it's at 48. Okay. Not too long ago, it was at 240. Now, you could say, well, 240 is crazy, but you know what? If you bought the stock at that point, you would have made a lot of money. So, right, it's not right to say that, oh, the PE is high, don't own the stock. It's actually, that was the opportunity to buy the stock. The earnings were depressed. And that was the time to buy. So often people draw exactly the wrong conclusions when they look at PE ratios.
Wow, interesting. Thank you for doing that. That is very cool. I do know that people think that PE ratio of, let's say, 10, 15 is good. That means it's healthy and your price is fair. But then when we talk about 60, 70, 80, 100, people are going, that's too expensive. And what you just said is, well, it depends on what you think the future is going to be. And one of my biggest complaints is that the standard PE ratio that you see when you look up, a stock chart and you just look it up everywhere, it's always looking backwards the last trailing 12 months. And I say, I'm always upset with that. They should at the very least, look at future PE, right? A forward-looking PE. Let's look at the next 12 months. That's what we should be looking at the very least. That's just one of my pet peeves.
Yeah, no, you're absolutely right. It's akin to driving a car while looking in the rearview mirror.
Yeah.
Right. What is past, and if the future stock price is no if the past stock price is no indication of future performance, then the past PE should be no indication of future performance as well.
Yeah.
Right. So exactly, you're right. It's really very useless. It may give you some sense of the valuation of a company, but when Nvidia was trading at 240 times the trailing 12-month earnings, all that really told you was that earnings are likely depressed. And the question is, did you believe that they would come back? And if you did, then it was an heroic move to buy the stock at that point.
Interesting.
Right?
I love this. This is a great example here. Who bought Tesla Nvidia 250 on last year? It literally was last year.
Yeah.
Just last year. And if you didn't, oh my God, you 3x, 5x what your company, your stock. But if you didn't because you're thrown away by that, yeah, you made a mistake.
Yeah, it was last year, but it was the trailing 12 months before that. So it's kind of earnings from 2 years ago.
That's the stupid part of this whole thing. Okay.
Yeah. All right. So now let's flip it around as you suggested and look at forward. So next 12 months. NTM is next 12 months.
I see. Next 12 months. Okay. Thank you.
All right. So now Tesla is trading at 72 times next 12 months.
Even worse. Mm-hmm.
Right. So that tells you a couple things. The earnings expectations could be too low.
Mm-hmm.
Right. Investors are saying, oh, we're going to pay more than, we're happy to pay more because we think earnings are too low, that earnings will be revised. Right. So they're playing that game of the expectations. Right. Or they could be saying, well, we don't really care about next year's earnings. We're actually looking at 18 to 24 months from now. We're going to look through this period and say, okay, yes, earnings are going to be depressed for 12 months, maybe not, but we're going to buy the stock based on what the company's going to do, maybe 2 years from now. But most of Wall Street does look at, earnings expectations over the next 12 months, maybe 18, 24 months if they're lucky. Okay, and they put the greatest weight on the shorter term periods. My argument here is that for a growth company who's going to generate most of its value in the future, not the next 12 months, right? Tesla has a long growth path ahead of it. That it's a mistake to use a valuation measure that just looks at the next 12 months. Right? It's a bit like looking at your child when they're 10 and say, I'm going to only look at what you do from now until you turn 11, right? To decide how useful you're going to be as a human being. Right, that would be my analogy. It's ridiculous that, right, you have to look at the whole lifetime. Now, of course, when a child is 10, you don't know what they're going to become. So there's a lot of uncertainty. I'm not suggesting this is easy.
Yeah.
Right. And same thing with companies. We don't know what Tesla's earnings path is going to look like. We have a lot of clues in their businesses that they're working on and the future potential of those businesses, which is why I model the company the way that I do, right? I look at the unit economics of these products and then try to look forward and say, okay, how big is this market going to be? What might this look like if we have, 100 million robotaxis or 1 billion humanoid robots? And then that gives us some clue as to what Tesla might look like in the future. There's no precision with that, but it's still much more helpful than just looking at a PE ratio over the next 12 months.
Love it, yeah. So this is Tesla's PE ratio looking forward. The next 12 months is 72, which is, again, pretty high. Then we shouldn't say what is high, what's low. We don't know. Thank you for teaching me that. NVIDIA is at 30. Okay.
And again, look how this has bounced around.
Yeah.
It's ranged between 75 and 24 on this chart.
Yeah.
When was it a good time to buy the stock?
Right. It's hard to know now.
right?
Yeah. In some cases, a low PE is a good thing because the price was actually down, like Tesla's was here in January 23. It was $100. That's why it's a low PE.
All
Uh,
things being equal, relative to itself, a low PE is good.
mhm.
Sure, absolutely. If you can get it at the cheapest price you can, absolutely, the lowest PE is good. Yes. But it doesn't necessarily mean that a high PE is bad.
There you go. Nice. Okay. I like the way you said that.
Yeah.
Okay. So what is this thing called? The hindsight PE. This is your own terminology, right?
Yeah. So this is a little bit confusing. Let me see if I can explain this.
Yeah.
Okay. So if you're a long-term investor, you may say, okay, it's 2018 and I've done research on Tesla. I'm a big believer in EVs. I think they're going to do well. The company right now is making no money, but I'm an investor at least for 5 years.
Mm-hmm.
Okay. I don't care about 2019 earnings. I don't care about 2020 earnings. I don't care about 21. I only care about, let's say, 2022 or 2023.
Okay.
Looking back with hindsight, if you were that investor 5 years ago, you could have bought the stock at 4 or 5 times 2023 or 2022 earnings.
What actually happened? Mm-hmm.
What actually happened. And again, I call it hindsight PE
Mm-hmm.
because you only know in hindsight how low it was.
The actual PE, if you had clairvoyance in
Yeah.
2018 and when you by 2023, which is 5 years later, the actual PE turned out to be 4, not whatever
4.
they were saying at the 2018. Yeah.
Yeah. 4 times earnings, which for a growth
Nice.
company is pretty cheap.
Crazy. Yeah.
Right. If you buy any company for 4 times earnings, any company that survives for 4
Yeah.
times earnings, that's a pretty good deal.
Yeah.
Right. And again, this is more illustrative. I'm not suggesting that this is easy to do or that anybody has the clairvoyance necessary to
Yeah.
say, oh, I'm getting Tesla today at 4 times earnings.
Yeah.
We don't know what the future earnings will be with any certainty. But
You
again,
know,
if we look at the potential of the business and
this
where
is the
they
PE
could be,
ratio. 2018 was around, I'm just taking a quick look here. It's around 760. At that time, it said the PE ratio was 60, trailing 12 months.
trailing.
Trailing 12 months. And so, but actually, it ended up becoming that 60 was not right because it was looking at trailing 12 months, not the future. And 2018, 5 years after 2018 is.
Yeah, sorry, you were looking at the green chart. That's NVIDIA. Go back to the blue one, I think, for Tesla on the previous.
No, I went. Oh, sorry. Yeah, I don't have it because it doesn't go all the way to 2018.
Oh, sorry.
Okay.
Yeah, it doesn't go back that far. Yeah.
Okay, sorry. You're right. That was NVIDIA's. Okay. Anyways, keep going.
Okay. All right. So the 30, so the blue bar on the left, the 30 represents if you bought the stock at the end of 2022, the first blue bar, yeah. If you bought the stock at the end of the year in 2022, you paid 30 times 2023 earnings. The next blue bar, 63. If you bought the stock at the end of 2021, you ended up paying 63 times 2023 earnings. Next one, 55. If you bought the stock at the end of 2022, you paid 55 times earnings. The next one, bought the stock at the end of 2019, you paid 7 times earnings.
Yeah,
and the end of 2018, you paid 4 times earnings.
Gotcha.
Okay. So what I'm trying to say here is that for longer term investors who don't care about what Tesla earns next year, if you understand the company and you believe it's on a trajectory where it can make materially higher profits over the long term, you can buy growth companies for very, very cheap multiples.
Gotcha.
Okay. Now, again, you only know in hindsight exactly how cheap it was. Right. But you have the ability to arbitrage time in a way that Wall Street does not have. Wall Street is compensated based on this year's results. They need to perform in this calendar year. So if Tesla has a year where the earnings are down, they're out of the stock. They're only interested if Tesla can start to exceed expectations. And it's those kinds of down periods that typically create the greatest opportunity for longer term investors to say, yeah, I don't care about this year. It's a terrible year, fine. But you know what? We're getting the stock at what will probably be a ridiculously low long-term PE multiple.
I love it, Cern. This is great.
Right?
I've had a conversation with somebody else who, and institutionals, and I said to them that we can actually be both correct at the same time. You are saying that it's too expensive at this point because you believe earnings are going to fall next year. You don't see the future, and you're maybe correct. But at the same time, I'm correct because very likely every single year, even though the stock doesn't perform, the business is performing. They're making growth and you can see the disruption happening. You're seeing the advancements in autonomy. At some point, when autonomy does become reality, we're going to be looking back and going $300 a share, $200 a share, because if disruption happens, that's the big if, and we believe, some of us think that it's going to happen within 5 years. Some people think it's going to take 5 to 10 years or longer. Then we're both correct. You know?
If you
Yeah.
go to the next slide, let me show you the benefit of this approach.
Yeah.
This is Tesla's year-end market cap at the end of each of these calendar years.
Okay.
Okay. So let's focus on 2023. At the end of 2023, it was a $660 billion company.
Yeah.
If you took the Wall Street approach at the end of 2022 and you said, okay, I'm going to buy the stock now because the earnings or whatever, and I'm going to buy it, you made 50%.
Mm-hmm.
Okay. It went from 456 billion to 660. You're looking really smart. Okay. But look at the investors that bought 4 or 5 years before.
Yeah, these
In
guys
2019, 104 billion, or
Yep.
2018, 53 billion. Those long-term investors that said, you know what, I don't care about short-term earnings. I believe in this company. I understand where they're going. They're going to produce more revenue and earnings into the future. I don't know what they are, but it's going to be materially higher than where I see it today. Those investors are sitting on like a 10 or 12x return, right? From 2018, I think it's a 12.4x or something return. So you have the ability here to not play Wall Street's game, which is the next year or two out, and look longer term and capture those gains. Wall Street is not even playing the game back in 2018 and 2019. They're not going to take that risk of what Tesla's earnings are going to be 5 years from now. They only invest if they think they have some visibility into what the earnings will be this year or next year.
Mm-hmm.
I'm not suggesting this is easy to do, but long-term investors do have an opportunity to play a completely different game than Wall Street's playing.
Yeah.
The challenge with it is shutting out the noise.
Mm-hmm.
Right? You're going to hear in the media and on X and on various videos on YouTube, people talking about the stock and the short-term performance and how disappointing this quarter is and the next quarter and the technicals of the stock and all that stuff. That's fine. That's all short-term stuff. Right? That's not positioning you for 10 or 12 or 15x kinds of returns. Right? You might get 20 or 30 or 40 or 50% if you're lucky. What I'm talking about is a completely different approach. Looking out 5-6 years instead of 1 or 2.
Yeah, as a disclaimer, right? Neither you and I can predict the future. We don't consider this to be financial advice. We don't know if this is what's going to happen. What you're doing today is explaining how to look at the PE ratio, not just Tesla, but any company. What's the fallacies if you look at the previous 12 months or just the forward-looking. Some point you need, if you're a long-term investor, you should be looking at longer than just 1 year forward. Then you've looked at the previous market caps and PE ratios of various companies, Tesla and NVIDIA. We don't know what's going to happen in the future, but it's a nice way to explain, just, understand the metric of PE ratio, which is people can easily just misinterpret what it's actually saying and what it isn't saying. So thank you for doing that.
Yeah, you're welcome. And it's particularly challenging when you have some volatility. You can see in Tesla stock here, the market cap went up and then it's come back down.
Yeah.
So you're going to have some periods here where the PE looks, ridiculously high, or it looks like you may have overpaid for the company.
Mm-hmm. But meantime, income is not volatile.
It's not as much. It's gone up quite nicely.
Yeah.
If you were to buy the stock in 2018 and 2016, Tesla wasn't making any money back then. So it would have taken some courage.
Yeah.
Right. To understand what may come for the company. Just like it takes courage today to understand how Tesla's business model is changing and what may come for the company. Right. So let's just skip ahead a little bit here, Herbert, and go to the NVIDIA charts and just share that one. Yeah, skip these two. There we go. Next one. Yeah, here. So this is NVIDIA's market cap. Right, and you can see, we know NVIDIA's done extremely well. This is the end of 2023. NVIDIA had a 1.6 trillion market cap. Today, it's much higher than this, but I'm just cutting this off at the end of 2023. Yeah. And if you can go to the PE chart for NVIDIA, here you can see the earnings growth of NVIDIA on the previous chart. right?
Yep.
So Jensen
Crazy.
from 2018 on was talking about the future of AI, right? So
Nobody believed them.
if you did
Hmm.
the research and understood the potential, you can build a position when expectations were low. Everybody was focused on gaming, right? And you can see that their earnings in 2022 went down a lot, right? Does that remind you of any company that we know of that had a tough year,
Exactly. Yeah.
right? And then 2023, the business changed. And in 2024, I think we're looking at about 60 billion in earnings for Nvidia,
It's crazy, eh? 10x in
right?
just a couple of years. That's what disruption looks like.
It's what disruption looks like. It's what AI looks
Hmm.
like in terms of when you get that right and can position yourself on the AI wave, the opportunity,
Hmm.
right? So again, we're cherry picking a very successful company here, but it's illustrative, I think, at the point. And you can see here that you could have gotten Nvidia at 3 times their 2023 earnings
If you had invested 5 years before.
if you had
Hmm.
invested 5 years before.
Sure.
So this is the opportunity that longer term growth oriented investors have. You can actually end up getting companies cheaper than what a value oriented investor might find a stock for.
Gotcha.
Here's just the numbers for Tesla and Nvidia side by side, and I added 2024 on there. You can see that Tesla's net income this year is likely to be materially down, although I just simply took the first and second quarter and doubled it. That's not really the right way to do it, but just for the purposes of this, just did a very simple approach. And same thing with Nvidia. So if Tesla can follow in Nvidia's footsteps and generate, you know, a massive increase in net income over time, then chances are buying the stock, 4 or 5 years before you'll end up buying in hindsight at a very low price.
Yeah. I've been saying this recently, and I'm becoming much more convinced that this is correct. That the difference is that there's people who are long-term investors, but believe that with that the disruption is going to happen within 5 years, and we could be absolutely completely wrong, right? That the
Yeah.
bot will be material to the business within 5 years. Elon himself just yesterday said he thinks that we'll be at a 1 million bot run rate by 5 or 6 years from now. You don't need to be at a million run rate for it to be material and for the business to be clarified. But there's, and same thing with autonomy, right? I think that autonomy will be in a revenue generating program within 5 years. But the people who think that no, it's like some people say not in my lifetime, some people say decades away, but some people go, yeah, sure, but 10 years from now. That's the difference. And they might be right. I might be wrong, but that's
Yeah.
the bet that we're making now. It's like that's why I think that the price today may be lower than what it will be 5 years from now. Some people think it's actually going to fall, right? Because you're just betting on wishes and dreams.
Yeah. And as we've seen, when it comes to time frame, if you wait until it's a sure thing, if you wait until it's built into expectations, then your upside will be less. If you're comfortable taking that risk now, your upside potential is greater, right? It makes sense. There's more risk, right?
Yeah.
There's more uncertainty. So the upside should be greater. We've
Uh-huh.
already seen that with NVIDIA. We've already seen that with Tesla in the past. The investors that took the risk early on when there was uncertainty or when there was difficult times in their business, they were handsomely rewarded for that risk. So it's fine if folks don't believe it and don't want to take the risk. Don't
Yeah,
fault them for it. That's fine,
that's fine. Yeah.
right?
We'll just wait until you see another milestone, another milestone. Then
Yeah,
you go, okay, maybe it's coming sooner than I think. And then you can wait for that. You don't have to take the huge
yeah.
bet too early. That's true too. Yeah.
But I believe that Wall Street won't get excited about this until that it's actually in their models and they can actually look at the next year's numbers and see that tick up.
Yeah. Yep.
Now, what we've seen with Nvidia and Wall Street is Wall Street's constantly behind the curve. They're constantly having to revise their expectations up again because they're focused on the short term. They don't really
Yeah.
understand the bigger picture.
I think it's fair to say that they typically focus on the stock price and what they think the stock's going to do versus
Yeah.
focusing on the business and the product and watching innovation happening and disruption happening. And that's what we typically like to do. This is one of our shows that is really all about the stock today. Thank you so much, Cern. That was great. I thought I knew PE ratio quite well. And then there's a few things here that you pointed out to me that was quite nuances that I hadn't given some thought on. I appreciate it. I learned a few things today on PE ratio. because I kept saying to you, I only believe in the forward PE 12 months. And of course, I'm a long-term guy. Look at 2, 3, where it is today. But this idea that even 12 months, it could be wrong too. So thank you for that.
Maybe just another real simple, quick way of helping people understand this is, let's say you were buying a real estate rental property. Well, it's certainly instructive to look at what the income was over the last 12 months. That's helpful. And it might be instructive to look at what is currently booked and what potential revenue and income will be over the next 12 months. But what happens if you're living in a community where suddenly you know that 2 years from now the laws are about to change and you won't be able to earn that income?
Yeah.
So unless you're looking at the full future of potential cash flows, you're going to miss something important. Right, that's a situation where it's negative, but it also could be maybe the laws changed and you're able to raise rents for whatever reason because something is being built down the road 2 or 3 years from now that makes your property more appealing. Right, as a real estate investor, you would be foolish to not take that kind of thing into consideration. You'd want to understand the full trajectory of what's going on around you when you buy a rental property. Right, so it's exactly the same concept with a company and stock as well.
All right. Thank you so much, Cern. Follow him on X at Cern Basher. Thank you, everybody. Bye-bye.
Thanks, Herbert.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.